to this March 30th episode of the GoNoGo show here on StockCharts TV. Thanks so much for tuning in with us. I'm Tyler Wood, calling in from New York City, and there's my friend Alex Cole. How you doing today, buddy?
I'm doing all right. I'm not in New York City, but I'm just across the bridge. You should try to get out here for a coffee.
That's right. To be so close and yet so far away. Well, thank you all for joining us. If you're watching this on YouTube, make sure you're liking and subscribing to the StockCharts TV channel, but also check out GoNoGo charts on YouTube. Alex, let's dive into the markets. Some positive news, some constructive evidence from the markets themselves. None of that appears in financial news media. All desperate and downward-facing headlines. But let's start with our cross-asset heat map, just to get a top-level view on where we're at from absolute trend perspectives.
And it's like you said, sometimes it's best to just look at the charts and look at the trends and see what the market's actually telling you, rather than listen to all the doom and gloom. It's certainly been a couple of weeks of banks blowing up and all the rest of it, but certainly some evidence in the charts that perhaps some signs of constructive price action. You can see that the equities along the top panel have painted a couple of amber go fish bars, so trying to climb out of this no-go correction, which, as we'll see in a little bit, is a new higher low. So that's something to keep an eye on. Treasury bond prices are painting aqua go bars. Remember, Treasury bond prices move inversely to rates. So perhaps a little bit of relief there with rates moving lower. Commodities still in their no-go trend, but that's weakened this week. We're seeing a string of pink bars. And the dollar, of course, after going back into a go trend, has fairly quickly rolled back over into a strong no-go.
Alex, if you don't mind, let's change this into a weekly view. So for everybody who watches the GoNoGo show each week, we talk a lot about time frames in all of our presentations, and just how important it is to understand where your trading is happening and what your time frame is, but to look at multiple perspectives and to zoom out on occasion. So on a weekly basis, the S&P 500 has entered a strong go trend. Of course, we're recording this 11 a.m. on Thursday, March 30th. So the week is still in play, but the constructive evidence of this resolution from 2022's bear market seems to be compiling more and more in favor of the bulls. And I think for today, when we look at the end of the month, the end of the quarter, we want to look at some of those longer term charts to really understand what we're looking at for the entire year ahead. So Alex, let's go through
too, Tyler, just to jump in on what you were saying there. What you see is some of the things we were seeing on the daily are lining up now with what we're seeing on the weekly. Like we were talking about the dollar rolling back over into a no-go. Well, the dollar has been in a no-go now on the weekly chart since the beginning of the year. So that's lining back up with the larger time frame trend with the dollar. Commodities in a no-go on the weekly. So that's in line with what we're seeing on the daily as well. And now, of course, the big change is in equities painting go bars on the weekly and those amber bars on the daily. So it will be interesting to see if we climb out of those no-go through the amber bars and perhaps into go bars on the daily in the S&P.
Absolutely. I'm here this week in New York for a student investment conference, Alex. The Game Forum hosts a couple thousand undergraduate students. And this morning's keynote address with Tom Keene, he said, good news doesn't make for very good financial TV. He's asking all of his panelists to talk more about their recession fears. But truthfully, the data from the markets is the best thing that we have at our disposal to take action. So let's look at the S&P 500. I see you've got that up on the daily. Let's take a look at the weekly chart first.
Yeah,
and absolutely. Just understand how this sideways resolution from a trend following perspective, you can have a lot of constructive evidence and some healing of that bear market activity just over the course of time, right? Let's not forget about the x-axis and all of the power it has to influence our charts and the data that we're looking at.
Yeah, and it was a strong period of correction. For just about a year, we saw this strong period of no-go correction. But what we've been talking about over the last few months is how if we hold these price levels, then that'll be another higher low. So we had a slightly higher high on the weekly, but we didn't climb out of amber bars. We moved back lower, but then we got a slightly higher low. And now we have moved into go colored bars. So this is, it's a nice way to read the charts, and we like to see the right side of patterns really show us the change. And you can see that as we went towards the right side of this correction, we're seeing more pink bars, we're seeing amber bars, and now finally the go colors. And you can imagine, you can sort of put your trend lines on here, because obviously there's nothing else on the price panel, but you could be looking at a bit of a neckline here, and we could be looking at breaking through in what could be considered some kind of head and shoulders pattern, or perhaps you want to talk about it as some other kind of formation, but we try to sort of stay away from labels like that and just look at the price action. And towards the right side of this chart and this pattern, we are seeing constructive signs as we lose the no-go colors, go into the uncertain amber bars, and now, of course, finally the go colors. And then if you look to the lower panel, confirming that, or really sort of backing that up, is the fact that the oscillator made a higher low. We saw that bullish divergence. Obviously, this is long time periods. We're talking about bullish divergence over the course of sort of 6 months, leading to these higher lows. And then, of course, the oscillator getting to the zero line, struggling to break away from it as we saw the uncertainty in price. But then we did see a break into positive territory. Now we're back at the zero line. So very, very important here as the squeeze builds, the go-no-go squeeze, the climbing grid tells us that we've had a little bit of a tug of war and a low directional momentum over the last month. But if we can find support again at the zero line and rally into positive territory, that would be a very strong confirmation of the new go colors in the price panel.
Absolutely. As all trend followers do, we want to see price action confirmed by momentum, volume, and from those volatility squeezes, we know that trading in the direction of the break is going to put you on the right side of what can be high velocity moves. So we'll be watching that over the weeks to come. Alex, let's take a look at some of the higher level sort of macro influences on the equity space. Let's start with the chart of the TNX, the 10-year Treasury Yield. Lot of discussion about the volatility that's been happening in the 2-year, the short end of the bond curve. But let's stick with TNX for right now, and why don't we even bounce this out to a quarterly view?
Sure.
The longest term perspective, and we've talked about this throughout the last couple of years, every week on this show, about just what a major trend inflection this has been, and what caused a lot of the volatility, certainly in the collapse of Silicon Valley Bank and Signature, but also for investors broadly, not being used to a rising rate environment really took a lot of investors by surprise. What we hear from a lot of the analysts and clients right now is that it's important to remember trends can move in 3 directions, right? Moving up, down, or being stuck sideways. And I think the commentary from Chairman Powell last week at the Fed meeting, we might remain higher for longer. They still are trying to tame inflation. And so settling in at these rates for some time might be able to push that target rate down towards the 2% that they're looking for. So when we see a trend like this, we have broken a 40-year downtrend line that started sometime around when Alex and I were conceived. But that break above on a quarterly basis into a week go trend, for this chart right now, we could see some perhaps consolidation, taking a breath there, processing some of those gains. Maybe not making moves significantly higher, but certainly remaining elevated for longer.
Yeah, and I think it's important to note that we've been at such historic lows, but it doesn't mean that we didn't have sort of bull trends in equity markets throughout the 40 years. So we, if, like you said, if we digest the fact that we might be at elevated levels for a little while, it might be possible for markets to still do well. It's that speed or that increasing, that rising rate environment, obviously, that puts a lot of pressure on markets. But if we do settle and consolidate, that might give the market a chance to move higher. We have moved higher in higher rate environments. It's just that the speed at which we got there put a lot of pressure over the last year or so. So we'll see what happens, as you said, if we can consolidate sideways perhaps for a little bit, that might take some pressure off stocks.
And let's jump this back down to the daily perspective. We talked about some bond buying, some go trends in the sovereign bonds, meaning that the inverse move in rates or yields is bringing those into no-go trends.
Yep.
Talk to us about what we're seeing there.
Yeah, and so this is what we're talking about. Could be providing some relief to equities. However, we did see some strong support held. You can see how we dropped below on this bar, rallied right back up to these levels that were prior lows. And so we have seen some support here. Now, we are still in a no-go trend, and we are facing the zero line as possible resistance. And we would look to see if we get rejected at that level. Excuse me, in which case we may well see price try to move lower and test those lows again. So we're in a no-go, and we'll look to see if rates move a little bit lower in the coming days.
Absolutely. All right, let's check in on the US dollar. We use the ETF UUP as a representative proxy for the dollar index. That also gives us some volume information on where this trend is headed. Also in a no-go, certainly taking some of the wind out of those bearish sales during that strength in the U.S. dollar that run last year. So, Alex, right now we're in a strong no-go trend, but I see a max squeeze building at the GoNoGo oscillator.
Yeah, and I threw it to the weekly, Tyler, just to give that long-term perspective again. But you can see strong no-go. Obviously, this is a lower high. As we move down, we can see that the oscillator has risen to challenge the zero line and has got stuck there. And that's caused the climbing grid of the GoNoGo squeeze to rise, as you said, to its max. Now, that tells us that there's a bit of a tug of war here in terms of momentum. And so we'll look to see if the oscillator gets rejected by zero, breaks out of the squeeze back into negative territory. That would be in the direction of the no-go trend. If that happens, that would tell us that momentum is resurgent in the direction of the trend. Of course, counter to that, if we break into positive territory, that would be a bit of a threat to the no-go. But at the moment, no-go trend in place, oscillator riding the zero line in a max go-no-go squeeze. So we'll look to see what happens there with the zero line.
Fantastic. Let's take a look at chart of gold. GLD is the ETF that we track. To get us a sense of sort of that volatility in safe haven assets. We're back into a strong go trend. We've got momentum that found support at the zero line, digesting a little bit of those quick gains from earlier this year. Alex, what are we seeing from the longer term perspective? If you even just span out a little bit to show us a little more of that weekly data. Where's our next layer of resistance?
Yeah, I mean, you can see this long sort of drawn out sideways / corrective action that we're seeing in gold. We can see how we failed so miserably really at these prior highs, almost to the dollar, and so that's really our next challenge for gold. You can see that we're in a strong go. We found support, as you said, at the zero line. So we made a higher low. We made a slightly higher intermediate high, and now this is where we'd be looking for that next level of resistance, right up here at these two prior highs. But gold has certainly moved in upward direction this year.
Absolutely. This is where the relative charts play a big role. When we're thinking about asset allocation, we want to take a look at things from both an absolute trend perspective, but also on a relative basis. Just before we leave the macro picture, let's take a quick look at U.S. oil, also on that weekly time frame, so that we get a sense of where we're at here at the end of the first quarter. Yeah, and again, this has been a very slow-moving chart now for several months, and you can see that we're in this no-go. It's creeping lower. A couple of weeks ago, we made a new low. We are below zero on the oscillator, not getting too far away from that zero line, though, so we really haven't seen some enthusiasm to the downside in this no-go that you might expect on each lower low, but we have been able to respect the zero line as resistance for this entire move. So we're in a no-go, strong purple bars, oscillator back to zero again. And you just look at how many times it's tagged the zero line and found that to be resistance. So we'll look to see
if that happens again. If it does happen again, look for price to move lower again and challenge these lows as it sort of creeps ever onward in this no-go trend.
Absolutely. So seeing some of the commodity space, pulling down the inflation narrative, right? Seeing materials costs come down. We're still tracking a resurgent consumer area of the markets. We're seeing a lot of folks in terms of consumer spending, household goods, that's still driving strong PPI and CPI numbers. So inflation is certainly not tamed yet, but keeping an eye on this macro picture and some of those sharp rallies in the commodity space through the pandemic are certainly waning. And that's the picture that we're looking at here. All right, Alex, let's dive into the S&P 500. Let's get under the hood and look at the sector groups on a relative strength basis. So we're going to use a GoNoGo rel map to take a look at all sectors against the benchmark S&P 500 index. So as we pull up that heat map, one of the things to keep in mind is that we care a lot about absolute trends. But from a tactical asset allocation perspective, we want to make sure that we understand where leadership and laggards lie in the markets. And let's take a look at this on the weekly view first.
Yeah,
Alex.
Absolutely.
What I think we've established in this show over the last few weeks is that we want to pay attention to rotation. And
Yes.
Right there on the right side of the chart, clear as day, in the month of March, we saw a pretty significant trend shift where we had underperformance, no-go trends in all of our growth equity sectors: technology, communications, consumer discretionary. Outside of consumer discretionary, we've seen tech and communications suddenly surge into outperformance of a rising S&P 500. That new leadership in the tech space is certainly causing some fairly thin breadth numbers. We're seeing those mega cap growth names that were the darlings of the stay-at-home trade during 2020 coming back into their leadership role. And if you look at this heat map, our center columns there are going to be a lot of the cyclical sectors, the energy, financials, industrials, and material sectors that had been our strongest performers through the bear market. Those were our leaders. They have rolled over as well, and we're seeing no-go trends on a relative basis to the S&P 500. Of course, the first rollover happened in the most defensive sectors. So that's consumer staples, healthcare, and utilities. Alex, from this rotation that we're seeing, right? Defense is off the field. We're back into growth equities playing offense. From this longer term perspective, what should investors be taking away in terms of how they might be positioning their portfolios for allocation?
Well, I think you walked us through, really the scope of this very clearly, and it just stands out that we learn about this stuff. We learn about it out of the textbooks, and it's sort of so easy to get wrapped up in the details and forget the bigger picture. And I think that's what hits me the most with this map, is that we learn that when we're in a tough market, then defensive sectors should outperform. And yet you kind of forget that sometimes, and you're in the weeds trying to figure out exactly what's happening. And if you just step back and look at this map, you can see that the defensive sectors, healthcare, staples, utilities, they were in relative go trends for almost the whole year, during which the market struggled. And so you need to really remember and step back and take a deep breath and think, okay, is what's happening, is it sensible? Does it make sense given what we know about how markets work and about how technical analysis works? And yes, it does. And the correction that we saw was brought down largely by the relative underperformance of the growth sectors, as you mentioned, which were the leaders through the massive rally we had since pandemic lows. And so just looking at this chart, you say, okay, things are doing what we should sort of expect them to do. And we should pay attention to that bigger picture and not get so wrapped up in the day-to-day. And if we're looking at the big picture now, as you said, clearly we've got a rotation into a couple of the growth sectors, not discretionary yet. We'll keep an eye on discretionary, but certainly technology and communications are now, on a weekly basis, relatively outperforming the rest of the market. And you can see that happened a couple of bars before the S&P itself went into a go trend. And you can see that now people have moved their money away from the defensive sectors. So, you can follow what is actually happening in the markets. And now we are in relative underperformance on healthcare, staples, and utilities. So that's a fairly clear rotation that's happened for the first time in about a year. We have underperformance in defensive sectors, and we have outperformance in the more aggressive growth sectors. There's a very clear change that we're seeing on the rel map.
I think you highlight one of the most important parts of technical analysis, which is that we try to remain objective, not subjective, and control our emotions. And so when you think about how closely tied investors got to the things that were working for them through the rally off the COVID lows, or the things that were working for them through the bear market last year, the ability to be flexible, to change your allocation, to change your investment decision based on the information that you get from the market is critical to success. And remaining flexible and open to what might seem improbable, right? That we are not yet out of the woods from last year's bear market collapse, and yet we're seeing some of those growth equity sectors outperform the market. Reacting responsibly to what the market is telling you is really the key to success, and it's a lot easier said than done. Remaining objective and taking decisive action requires that you simplify your charts and you stick to your rules. So that was the idea behind creating GoNoGo charts, was to remove that analysis paralysis, to take away all of the extra noise that might happen in other forms of data visualization, so that you can see clearly when these activities happen. And rotation is a process, right? This is the entire month of March is just that rotation there on the far right side of the chart. So Alex, from the next step, investors might want to take a look at the industry groups that are outperforming in the sectors which are outperforming the benchmark. If you're looking for trade ideas and we're digging into the technology sector, let's pull up the industry subgroups of tech, because it's not the entire technology sector that's outperforming. And right here, we're seeing in that top panel, renewable energy equipment. Yes, technology sector does include renewable energies companies. And then we're also seeing semiconductors there in that third panel that have been consistently outperforming. We've talked about the semiconductors in the last few shows, so let's dive into renewable energy equipment and services. That the ticker is DWCREE. And if we look at that on an absolute trend, we can see that as an outperformer, we're seeing stronger uptrends than what we're getting even from the technology sector itself. It doesn't go up in a straight line, but we can see within this industry subgroup index that we have gained ground faster and found more support from a momentum perspective, breaking out of that max squeeze just in the last couple of days. Down in the lower panel, you'll see the GoNoGo oscillator breaking out of that max squeeze, which reconfirms the leadership of this renewable energy equipment index. So Alex, why don't we take a look at a couple different names within the space? Yeah. Let's start with First Solar. FSLR is the ticker. And when we're drilling down from index level to the sector groups, into the industry subgroups, and then into individual names, what we're going to see are similar pictures all the way down, but perhaps further evidence of that relative strength characteristic that we're looking for in our trade ideas. Talk to us a little bit about what we're seeing from this chart.
Yeah, like you said, it's clear how different this chart is to the chart of the S&P or to the chart of some sector perhaps, or some security that isn't performing well. We are clearly seeing higher highs and higher lows. We've had some small counter trend corrections, but each time we burst back into a go trend and make new highs. What's nice to see this time around is that we corrected against the trend as we moved sideways. The oscillator fell to the zero line and stayed there though, finding support as the GoNoGo squeeze built to its max. And now we've broken out of that squeeze back into positive territory. That gives us this green circle, which is our go trend continuation icon. So what that's telling us is that there's a go trend in place and the oscillators found support at the zero line. So momentum is on the side of the go trend. So we'll look to see if we can make new higher highs here. So a nice looking chart of First Solar in a market that has generally not been performing this well.
Absolutely. And like we always say, it is a market of stocks, not a stock market. So let's pull up a chart of Plug Power. PLUG is the ticker. Not all charts look the same, Alex, even though this
Right.
is also a renewable energy equipment chart. We're seeing that in an absolute opposite no-go trend to what we saw with First Solar.
Yeah, I mean, you couldn't have a clearer opposite picture for two companies in the same sub-industry group. And like you said, it just goes to show that if you were stopping your research at the industry group level, you'd be sort of risking some securities that are not performing as well as others, and some that perhaps are outperforming others. And that's important to note as well, that on the single security level, we can see different stories, and this is in a no-go trend, oscillator below zero, just made a new lower low. So certainly not contributing to the renewable energy outperformance as FSLR is.
Absolutely. Alex, as always, it is a pleasure to talk markets, and apologies that we can't be in person to have this cup of coffee together, but appreciate your view on today's markets, and we're looking forward to seeing all of you here on StockCharts TV every Thursday afternoon at 3:30 Eastern. And from all of us at GoNoGo Charts, we wish you a great spring. Stay safe, stay healthy, and we'll talk to you soon.
Thank you very much.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.